Hey everyone, and welcome to The Explainer. Today we're diving into a really massive shift that's happening right now in Nepal's cooperative sector. For decades, the cooperative model has basically been the backbone of community development and rural income generation. But as we all know, with rapid growth comes immense risk. So we're going to look closely at the newly enacted Directives and Standards 2081, which were issued to completely overhaul exactly how these institutions handle your money. So, is your money safe? Honestly, it's the single biggest question on the minds of millions of citizens right now. While cooperatives were originally designed to promote a harmonious society and really lift up marginalized communities, recent vulnerabilities have totally shaken public confidence. The new directives we're analyzing today, they were specifically drafted to answer this exact question with a resounding, legally binding yes.
Here's a quick roadmap of what we're going to cover today. We've got 1. The cooperative scale. 2. Mobilizing financial resources. 3. Lending guardrails and risks. 4. Capital maintenance rules. 5. Corporate governance and trust. And finally, 6. Protecting the member.
All right, Section 1, the cooperative scale. To really grasp the stakes here, just look at this number, 478.11 billion rupees. Wow, that represents the total savings mobilized by cooperatives as of mid-March 2024. And remember, this isn't just faceless institutional capital. We're talking about life savings, emergency funds, the seed capital for small businesses of everyday people. Managing a pool of money this massive requires absolute precision and rigorous oversight. When you break that scale down, the figures are just staggering. It becomes instantly clear why these regulatory guardrails are absolutely critical to prevent a systemic collapse. There are over 31,000 cooperatives operating right now, and they serve 7.85 million members. That is a huge chunk of the nation's population relying on these institutions. Plus, the sector provides direct employment to over 94,000 staff members. So a failure here isn't just a financial hiccup, it's an economic earthquake. Now, conceptually, cooperatives are fantastic, right? They're praised across the political spectrum by everyone from free market advocates to state control proponents for their role in community development. But actually, there's been this gap between the philosophical promise and the reality. The lack of a distinct tax policy separating them from private businesses, combined with, quite frankly, past instances of elite dominance, meant these strict new rules were absolutely necessary. It's really about taking an inherently good model and bolting on the ironclad rules needed to build unwavering public trust. Let's see how they're fixing this. Section 2. Mobilizing financial resources. This new rule right here is an absolute game changer. It ensures that a cooperative cannot aggressively expand its deposit base without actually having the underlying capital to support it. By capping deposit collections strictly at 15 times their primary capital fund, regulators are basically forcing cooperatives to grow sustainably. Put simply, if you want to hold more of the community's money, you need to have more of your own skin in the game. And what's really clever is how the regulations actively scale risk based on the size and reach of the institution. A localized cooperative just operating in one district, they're capped at accepting 10 lots per member. But a larger one, spanning multiple provinces, can accept up to 50 lots. Crucially, though, any member depositing over 10 lots must now mandatorily disclose their income sources. This isn't just about stability, it ties directly into national money laundering prevention. Okay, so we know how the money comes in. Let's look at how it goes out. Section 3, lending guardrails and risks. This is literally the end of reckless lending. I mean it. First off, you can't just join a co-op and immediately borrow money. There's a mandatory 3-month cooling-off period now. Second, no single member can drain the vault. Loans are capped at 15% of the primary capital per member. And this is huge. Large cooperatives, those with over 25 core, are now forced to disperse at least 50% of their loans to productive sectors like agriculture and industry, rather than throwing it all into high-risk ventures. Let's talk penalties, because this is where it gets real. Look at how severely a cooperative's capital is penalized when bad loans go unpaid. A perfectly performing loan, that only requires a 1% reserve. But by the time a loan is overdue by a year, classified officially as a loss, the cooperative has to provision 100% of that value. This massively incentivizes these institutions to aggressively manage and recover their loans, because if they don't, bad debts will literally eat their operational capital alive. But wait, what if members just want to withdraw their cash? Well, this directive ensures that the cooperative actually has the cash on hand by legally requiring a minimum of 15% of total deposit liabilities to be held in highly liquid assets like cash in the vault or super secure government bonds, the regulators have built a structural shock absorber to protect against sudden bank runs. Next up, Section 4, Capital Maintenance Rules. Under the hood, institutions are now tied to a strict mathematical baseline to prove their financial health. They've got to maintain a core capital ratio of 4%, and for the large-scale cooperatives, an 8% overall capital fund ratio against risk-weighted assets. And if an institution falls short, no way. They are legally prohibited from declaring or distributing any dividends to members until those strict capital buffers are fully restored. To actually prove their health, cooperatives have to rethink their accounting completely. Think of financial capital maintenance as just tracking the raw cash invested. Physical capital maintenance, on the other hand, asks, okay, but what can that cash actually do today? By adjusting for inflation and current costs, it totally prevents cooperatives from artificially inflating their profits based on outdated asset prices. All right, let's talk about the people running the show. Section 5, Corporate Governance and Trust. These new directives completely dismantle the historical conflicts of interest that, let's face it, have plagued this sector. In the past, a board of directors could just approve massive loans using themselves as guarantors. Well, not anymore. The rules now explicitly ban family monopolies on the board and audit committees. They impose a strict maximum of 2 terms, and best of all, directors are entirely restricted from misusing their positions to take personal loans or place themselves as guarantors. Along with that, there's a huge push to professionalize management. Regulators are completely separating the board's oversight from day-to-day operations. Now, to be a CEO or manager, you can't have outstanding loans from the co-op, you must hold specific educational degrees, and, this is a big one, you cannot be a member of any political party. It's a massive step toward ensuring that these cooperatives are run as sound financial institutions, not as political extensions or personal piggy banks. Which brings us to our final section, Section 6, Protecting the Member. Gone are the days of verbal agreements and hidden fees. There are now strict, mandatory onboarding steps to guarantee no member is left in the dark about their money. Before even joining, members have to receive financial literacy training. They must be handed a physical booklet detailing every single fee, interest rate, and policy. All loan money has to move transparently through the member's account, and large cooperatives are even mandated to have a formal grievance officer to resolve complaints. So, with all these strict financial guardrails finally in place, how will the future of financial inclusion evolve in Nepal? I want to leave you with this thought. We've just seen a sector responsible for nearly 500 billion rupees transition from an era of loose oversight to one of mathematically rigorous, ironclad accountability. The rules are clear, the boundaries are set, and the focus is finally on sustainability and member protection. Will these rigorous standards restore unshakable trust in community economics? It's going to be fascinating to watch. Thanks for joining me for this explainer. Keep questioning, keep learning, and I'll catch you in the next one.